Welcome to the next edition of Fixed Interest, where we will be discussing Mexico. My name is Shelly Shetty, and I'm a Managing Director and Head of Americas and Asia Sovereign Ratings at Fitch. Now today, I'm joined by Carlos Morales, who is a Director and the Lead Analyst for Mexico at Fitch. Now today, we are going to be discussing Mexico's recently held historic elections. We'll also talk about the opportunities and challenges ahead for the incoming administration, and also discuss some of the rating drivers going forward. As you all know, on June 2nd, Mexico held its presidential, congressional, and state elections. Claudia Sheinbaum of the ruling Morena party won by a landslide and will be the first female president of Mexico, starting her 6-year term on October 1st. Preliminary results indicate that Morena and its allied parties have attained a 2/3 majority in the lower chamber and came close to a supermajority in the Senate, falling short by just 2 seats. As such, the incoming government is well positioned to approve constitutional amendments. So, Carlos, how are you viewing the election result and what it might mean for governability and institutional strength of Mexico?
Thank you, Shelly. Indeed, Claudia Sheinbaum won the presidential election by a landslide, becoming the first female president in Mexico's history. Sheinbaum of the Morena party received 59% of the vote, nearly 30% more than her closest competitor, Xochitl Gálvez. This marks the largest margin of victory in any Mexican presidential election since 1982. The results signal broad policy continuity. Sheinbaum campaigned on a platform to continue the legacy of outgoing President López Obrador, or more commonly called AMLO. Her decisive victory represents a vote of confidence in AMLO's administration and solidifies Morena's extensive political support. Morena and its allies secured a supermajority in the Chamber of Deputies, but fell short by 2 seats of achieving supermajority in the Senate. Nonetheless, we expect they will be able to shore up enough votes to secure approval for constitutional reforms. This would include proposed modifications to the judiciary and the Electoral Institute, championed by the outgoing administration. The proposed judicial reform includes a significant change. Supreme Court justices, magistrates, and local district judges would be elected through popular vote. This reform, if approved without modification, will likely impact institutional quality, checks and balances, and possibly weaken Mexico's legal certainty, given greater concerns of government interference in judicial matters. While still early, this may risk affecting investment and growth prospects. Any erosion of the institutional quality will likely ultimately get picked up in World Bank's governance indicators, which is a direct input into our own sovereign rating model. Just for context, Mexico already scores very weakly on these indicators.
Now let's shift to the economy. How is the economy evolving? What economic opportunities lie ahead for the incoming administration? And do you see Sheinbaum's government leveraging on the nearshoring opportunity?
Sure thing, Shelly. On the economic side, we're seeing some softening signs as real GDP growth on the first quarter of 2024 came below our expectations, but we anticipate that the economy will pick up for the remainder of the year. We anticipate that investment will continue to contribute to growth, although moderating from what we saw last year, given that government projects are nearing completion. On consumption, will continue to be supported by a robust labor market, remittances inflows, and real wage growth. Finally, the U.S. economic growth and a looser domestic fiscal policy will also contribute to economic growth, although high monetary policy rates may dampen credit growth. For our forecast, we revised our 2024 growth to 2% from 2.2% previously as a result of the worst initial position. We continue to expect that headline inflation will slow down to 4% by the end of this year. However, in light of foreign exchange volatility after the election results, we anticipate only a modest decrease of the monetary policy rate to 10.5% from its current level at 11%. In terms of the opportunities that we're seeing for this administration, we highlighted that nearshoring represents an unprecedented opportunity for Mexico to deepen its global supply chain participation and expand its manufacturing capacity. Mexico's proximity to the U.S., coupled with strong economic ties and a well-developed manufacturing sector, positions the country very well to gain from shifts in U.S. trade relations and increased geopolitical tensions. In fact, Mexico became the main trading partner of the U.S. last year, surpassing both Canada and China. The contrast we observe between the overall decrease in U.S. imports demand and the sustained demand for Mexican products is an early indicator of the advantages that closer economic integration to the U.S. can bring. However, we continue to highlight that there are infrastructural challenges that may dampen investment confidence in Mexico. Among these are availability and affordability of energy, water scarcity issues, red tape, and the quality of logistical infrastructure. Furthermore, the weakening of checks and balances, along with increased legal uncertainty due to proposed constitutional changes, could further dampen investor appetite.
Now, Carlos, let's flip from opportunities to challenges. What do you see as the main economic challenges that President-elect Sheinbaum will face during her administration?
Reining in the fiscal deficit is among the key challenges faced by Sheinbaum's administration. The 2024 budget presented a fiscal deficit above 5% of GDP, its highest point in over 3 decades. The challenging fiscal position inherited by the incoming administration follows a combination of rising social spending, higher borrowing costs, and high investment due to the completion of priority projects of the outgoing administration. We anticipate government debt will increase to 49% of GDP in 2024, up from 46% last year, although remaining well below the BBB median at 55%. While the incoming administration has signaled willingness to narrow the deficit consistent with a stable debt to GDP trajectory, uncertainty remains on how and at what speed this will be achieved. Political appetite for a reform to improve tax collection remains unclear. Another major uncertainty is the U.S. election looming at the end of the year. Trade policy could differ in the U.S. depending on the winner of the election. For example, Trump has stated his intention of imposing a universal tariff of 10%. Increased trade tensions in such a scenario could leave Mexico quite vulnerable given that 80% of its exports are destined for the U.S.
Thanks, Carlos. One of the pressure points that we've obviously seen for public finances has been Pemex, given the company's weak financial situation. And this has obviously required persistent support from the government over the last few years. So how do you see the government support for Pemex evolving under Sheinbaum's presidency? And how do we incorporate Pemex support in the rating of Mexico?
Definitely. Pemex continues to be the weak spot for Mexico's fiscal position. We've seen that over the past 5 years, the federal government transferred Pemex $70 billion in financial support, which totals 4% of GDP, in detriment to the federal government's balance sheet and deficit position. However, we anticipate that the financial support from the government to Pemex will persist throughout Sheinbaum's presidency. The incoming administration has expressed intentions to preserve Pemex's dominant position in the oil market, which will likely necessitate federal transfers into Pemex absent any significant improvement on its operational efficiency. For the first time, the 2024 budget explicitly outlined support measures for Pemex. Previous support was provided on an ad hoc basis, adjusted in response to economic conditions. This inclusion in the budget enhances transparency and also underscores the government's commitment to ensuring Pemex's liquidity. While we expect Pemex to receive unwavering support, it remains to be seen whether the new government will continue to include this support in the following budget. In terms of how we account for Pemex support, we don't explicitly add Pemex's debt onto the general government debt, our preferred measure of comparison across the globe. Instead, what we do is we make a negative qualitative adjustment to our sovereign rating model, which incorporates our view that ongoing sovereign support for Pemex will result in a lower tax take and a higher general government debt burden, negatively impacting public finances.
So finally, Carlos, when you balance out all the opportunities and challenges ahead for the incoming president, how do you see the key rating drivers for Mexico evolving, and what can move Mexico's ratings up or down in the coming years?
Looking ahead, we'll be keeping a close eye on 2 main events that could affect Mexico's credit rating. Firstly, would be Mexico's fiscal position, given the deterioration on the fiscal balance that we've seen throughout 2024. The 2025 budget, which will be released by November, will be the first signal of the fiscal consolidation strategy outlined by the incoming administration and give us a chance to gauge fiscal consolidation prospects and their credibility. Secondly, changes to Mexico's governance and policy framework, given the constitutional amendment proposals, are critical, especially when they have the potential to impact economic growth and the overall business climate. Now, the factors that could trigger a negative rating action are three: a weakening in the consistency and the credibility of the policy framework, an upward trajectory of the debt burden, and finally, a deterioration in governance that results in political instability or undermines policymaking. Alternatively, the three factors that could trigger a positive rating action would be an improvement in growth prospects to a level closer to the BBB median, greater fiscal consolidation, for example, via revenue-enhancing reforms that would increase our confidence in a stable debt-to-GDP trajectory, or a reduction in contingent liability risks related to Pemex. And finally, an improvement in governance, for example, reflected in convergence in governance indicators closer to the rating category median.
Thanks a lot, Carlos, for your insights. Thank you for listening in. And for more on Mexico, you can access our research on our website, fitchratings.com. Hope you will join us in the next Fixed Interest podcast. Thank you.